Hey people, I welcome you all to Caroline's Online Academy. And what we are doing now is we're learning how to account for share capital using small concept problems in numericals, through which we are understanding the small concepts that are involved, which will help us build on to develop the knowledge that is required to solve the CBSE board examination 6 mark questions. In the previous video, we saw how to account for oversubscription of shares and when the company rejects the excess applications. Now, in this video, we're going to look at just the opposite, that is under subscription of shares. What if the company receives less number of applications than it had invited? That is, in case the company had invited the public to subscribe for 10 shares and it only received applications for subscription for, let's say, 9 shares or 8 shares or 7 shares or whatever it is, lesser than the number of applications invited by the company. That is a case of under subscription when the number of applications received by the company is less than the number of shares issued by the company or the number of shares that the company has invited the public to subscribe for. In such a situation, how to account for is what we're going to see now in this question. I have a question for you now. It is Kartika Limited. Kartika Limited issued 1 lakh shares of rupees 100 each, payable as follows. Application is 25, allotment is 20, first call is 20, and second call is the remaining. The company received 90,000 applications and allotted 90,000 shares. Pass necessary journal entries. Now, if you see, the company has issued 1 lakh shares, but it only received 90,000 applications. And it cannot allot 1 lakh shares because there are not enough applicants to subscribe for 1 lakh shares. So it has allotted the number of shares for which it received application, which is 90,000. So this is a case of under subscription. Now, when you look at how much the second call amount would be, the question says second call is remaining, right? So how much is the second call amount? It is the issue price minus the other installments. So issue price in this case is 100 rupees at par. And the application money that we have received along with the shares is 25, allotment money is 20, and first call is 20. So in all, we have received 65 in application, allotment, and first call. And so how much we need to receive in second call is 100 minus 65, which is 35. All right, let's start accounting for this. We know the first journal entry is bank account debit to equity share application. I have explained it enough and I've given the logic for the journal entry numerable times. So I'm not going to do it again. In case you're not understanding why a particular account is credited or why a particular account is debited, please refer the previous videos or the video in which I've explained the logic. You will understand why we're debiting equity share bank account and we're crediting equity share application account. Right, where people make mistakes in under subscription problem is they go ahead and calculate the amount as 1 lakh into application money per share, 25 lakhs, or they even go farther and calculate the amount as 1 lakh into 100 rupees and write 1 crore here. That is wrong, my dear children. When you have received 90,000 applications, you would have received 25 rupees per application. So the amount of application money received by us would be 90,000 multiplied by 25 rupees, the application money per share. Number of applications received multiplied by the application money per share, and that happens to be 22,50,000 in Kartika Limited's case. Application money received. All right. Now that we've calculated the application money received and accounted for it, the next thing to do would be to allot shares. We need to check if the company has rejected any shares or applications or not, because in case the company has rejected applications, we got to refund that money as we saw in the previous video. But in this case, the company is not rejecting any applications, and it's in a case of under subscription also, very less chance of rejection. And therefore, the next thing that we're going to do is allot shares. Allotting shares comes with two transactions. The first transaction is transfer the application money to equity share capital account, as the applicants have now become shareholders of the company, and the money paid by them would be what, my dear children? It will be share capital. So it's transferred to share capital account, and in this case the amount is 22,50,000, or the number of shares allotted multiplied by the application money per share. Number of shares allotted is 90,000 in this case, and application money per share is 25. So 90,000 into 25 will give you 22,50,000. Shares allotted. All right, so we're done with that. The next thing to do would be, after allotting shares, we make the allotment money due. That is, we call the shareholders and tell them that it's time for you to pay the allotment money. So that we're going to do now. equity share allotment account debit. Why I'm debiting equity share allotment and why I'm crediting equity share capital has already been explained by me many times in the previous videos. Kindly check them in case you're not comfortable or in case you don't know. Okay. So what would be the amount that we are supposed to debit here? People go ahead and multiply 1 lakh, the number of shares issued, with the allotment money per share and arrive at the amount here. That would be so wrong, my dear children. The company has only allotted 90,000 shares. The formula would be number of shares allotted into allotment money per share. Okay, so allotment money per share works out to rupees 20, or is given in the question as rupees 20. And so the amount that you'll make due is number of shares allotted, which is 90 in this case, into 20, 18 lakhs. Allotment money made due. All right, children. So we have made the allotment money due. Once we have made the allotment money due, what happens next? The shareholders actually pay the allotment money and the company receives the allotment money. When the company receives money, bank account will be debited. Bank account debit to equity share allotment account. As there are no defaulters, as there is no calls in arrears, the company would have received the full 18 lakh. Now you might ask me as to how I found out I mean, how am I deciding that there are no calls in arrears, so nobody has defaulted? In case there was calls in arrears, or if anyone has defaulted, the question would mention that. In this question, there is no mention of anyone defaulting any calls or installments, and therefore we are assuming that everyone paid up on whatever call was made. Understood? So allotment money received. Once we have made the allotment money due and received it, the next thing to do would be to make the first call due. So when it's time for that to happen, so equity share first call account debit. Again, the logic for the journal entry has already been explained. I'm not going to say that again also. Equity share capital account. Even here, we are supposed to multiply the number of shares allotted with the first call money per share. The number of shares allotted is 90,000 and the first call rupees per share is 20 from the question. I'm taking it from the question. I already know it, so I just put 20. So first call is 20, right? So number of shares allotted is 90,000 and 90,000 into 20 will give you the amount that you're supposed to make due along with first call. Equity share first call made due. All right, children. So once we have made the first call due, it's time for them to pay and for us to receive the money. And therefore, as there are no defaulters, everyone paid and we'll receive the money. The journal entry will be bank account debit to equity share first call account. That'll be 18 lakhs as there are no defaulters. Share first call money received. After that, we would make the second call due and receive the second call money. The journal entries would be the same. The amount we'll have to calculate. Journal entry would be equity share second call account debit to equity share capital, equity share second call made due, and bank account debit to equity share second call for receiving the second call money. Share second call money received. Right, the amount would be what, my dear children? We had already calculated the second call to be 35 in the beginning of the video, if you remember. We calculated it to be 35 per share and 90,000 shares have been allotted. So the total would be what, my dear children? Be 90,000 into 35, that is 31,50,000. As there are no defaulter, as there is no calls in arrears or anything, any other adjustment given in the question. So we are crediting the entire 31,50,000. As we receive the money from the shareholders. All right, children. So with that, we have come to the end of this Kartika Limited case, where it was a case of undersubscription. Through this problem, I hope you had understood how to account for when there is undersubscription. The only thing is you got to be careful with when you make the amounts due and when you make the when you receive the application money. It is a number of applications received into application money per share, and when you're making the amounts due, it is number of shares allotted into allotment money per share for allotment, first call per share for first call, and second call per share for second call. All right, children. So we'll see you in the next video with a different concept and a small numerical. You people take care, have fun, and